When you see a store that you know declare bankruptcy, there's probably a lot of reasons that you can think of. Amazon has slashed margins as people shop online more, and then a global pandemic happened.
But when all the stores were closed.
Both of those things are true, but there's also another reason why a lot of retail stores are declaring bankruptcies. Take some of the most recent. J. Crew, Neiman Marcus, Toys R Us, Hertz, all of them were obtained by private equity firms in leveraged buyouts. This is how it works. Private equity companies will buy a struggling company with the hopes of refashioning it, which generally means slashing costs, laying off workers, closing stores, all with the goal of taking this newly profitable company and spinning it off, selling it to someone or making it public. Now for the original shareholders, this can be a great deal. They're getting paid off with all this borrowed money. But for the company, it can hurt them. That's because that borrowed money becomes the responsibility of the company itself, not the private equity firm. This is how it works. So a private equity firm that you've never heard of, Pencil, buys a company that you do know, Eraser. But the private equity firm only spends $1 billion of its own money. The rest is borrowed. That $5 billion that's borrowed is now on Eraser's books. On top of that, the company pays out dividends and management fees to the Pencil. But in order to make those payments, the company might have to borrow even more money. That's called a dividend recapitalization. All that debt can end up being crushing for a company. Those interest payments that are growing and growing can prevent it from investing in itself to compete against, say, Amazon. And then when market conditions begin to turn, it can turn into a death sentence.
Be able to wipe out nearly $2 billion of debt.
Private equity firms say they're doing a service. They're taking these distressed assets, refashioning them and turning them around. And they can only do it because of a leveraged buyout. When they do that, they can take a public company private and avoid a lot of the rigmarole that a public company has to deal with, things like answering to shareholders. But it doesn't always work like that. Toys R Us was bought in a leveraged buyout in 2005 by equity firms KKR and Bain Capital, as well as the real estate firm Vornado. Of the $6.6 billion purchase price, $5.3 billion of that was debt that landed on Toys R Us's books. By 2017, that debt load had grown to more than $400 million in interest payments a year. With that debt load growing larger, Toys R Us struggled to find the money to invest in itself and compete with Amazon. But while Toys R Us went bust, its private equity owners still got paid. Over the years, Toys R Us gave its private equity owners more than $470 million in fees and interest payments. Years of cheap debt have allowed private equity firms to make these leveraged buyouts, and some of them have ended up in bankruptcy. So yes, there is a pandemic and Amazon continues to beat brick and mortar retail. But when a brand you know declares bankruptcy, there could be another culprit responsible.